In today's video, we will discuss NIO stock and analyze 3 articles related to it. The first article titled "Don't Let Q4 2022 Scare You Off" takes a bullish stance on NIO's future projections despite the underwhelming Q4 report in 2022. The second article is titled "NIO Inc. A Buy as Wall Street Analysts Look Optimistic," explores whether to buy, sell, or hold NIO stock and provides insight from professionals on the company's future trajectory. Finally, we will discuss the top 3 electric vehicle stocks to buy, including NIO, and why it is considered one of the top picks. So without further ado, let's get started. Despite the less than impressive result in the Q4 2022 earnings report and an easy guidance for Q1 2023, the author for the first article believes that NIO is a clear buying opportunity. The author also points out that the company recorded a 60.2% year-over-year increase in the vehicle sales, which is a positive sign. However, the company's vehicle margins dropped significantly, leading to underwhelming financial results. Despite a rough 2022, the author expects NIO to recover fundamentally in share price throughout 2023, particularly in the back half of the year. The company is well positioned to beat its overall deliveries and boost growth revenues in the next quarter. 2 catalysts are expected to contribute to the company's expansion, which will be discussed later in the video. NIO currently expects its total revenue for the first quarter of 2023 to be between 1.58 billion and 1.67 billion, which is significantly lower than its previous estimate of 2.78 billion. The short-term outlook for the company seems unpromising. However, 2 catalysts in the back half of the year will pay off, making it a long-term buying opportunity for investors. The stock may remain volatile in the near term, but the share price is expected to rebound at the end of 2023. The fundamentals of NIO remain intact despite competition from Li Auto and XPeng, both of which face similar problems in the Chinese macroeconomic environment. Investors should note that it is a race to see which company can bounce back the fastest. NIO is already on a growth trajectory and is in full recovery mode, making it unlikely that the NIO bearers will be right over the long term. The company is planning to increase its production capacity by building new plants for battery operations, charging stations, and battery swapping stations, as well as manufacturing facilities. As a result, NIO is expected to become the top competitor for other Chinese automaker in the future. The electric vehicle market is set for growth, with a projected compound annual growth rate of 23.1% between 2022 and 2030. This growth presents an opportunity for NIO, which is poised to capture a significant share on the market. Even if they maintain their current growth rate, they can expect a minimum CAGR of 20 to 23% and possibly more if they outperform their competitors. Therefore, NIO appears to be an attractive investment opportunity. NIO has distinguished itself through its BASS power swapping stations, which are being introduced in Europe. However, the impact of these stations has not yet been reflected in the company's earnings reports. Investors anticipate that the BASS platform will significantly increase NIO's revenues and earnings for the full year of 2023. The current share price discounted based on less impressive quarterly result for 2022, making it an opportune time to buy. Investors are relying on strong second half of 2023 and beyond. One of the challenges facing NIO is that their next earnings report, anticipated in the first quarter of 2023, may not meet expectations due to higher than normal battery expenses. Bloomberg NEF's annual lithium-ion battery price survey report a 7% increase in average pack prices for electric vehicle batteries. This higher cost per vehicle will reduce NIO's overall margins. From 2010 until the present day, there has been a notable and consistent decline in the prices of electric vehicle batteries, which is a positive development. However, in 2022, there has been an increase of around 7% in the prices, which is a negative trend. Ideally, we want to see prices continue to decrease over time, allowing electric vehicle makers to increase their margins. NIO has grown 2 catalysts in its favor. The first is China's reopening of its overall economy, which is likely to lead an increase in demand for electric vehicles, benefiting NIO and other makers. Additionally, NIO's expansion into Europe represents another opportunity for growth. However, the most promising catalyst is NIO's plan to release new vehicles during the first half of 2023. This will help diversifying their revenue streams and pay off in the second half of 2023 and beyond. Currently, NIO stock is trading at around $8 to $9, which is relatively cheap. Moreover, the stock is cheap compared to its peer group average in terms of its EV over C 2023 sales. Specifically, NIO trades at just 2.03 times the EV over C 2023 sales, while the peer group average is 2.3 times. As such, NIO is a better value buying opportunity. If you can identify value in a growth stock, particularly one that is trading at a relatively low price like NIO, this represents an excellent buying opportunity. This sentiment is echoed by Wall Street analysts, the majority of whom believe that NIO is buying opportunity. Out of the 31 analysts surveyed, 23 say to buy the stock, while the remaining 8 recommend holding it. It's worth noting that none of the analysts surveyed suggest selling NIO. The median price target for this company is 16 and the mean price target, which is the average, is 17. By comparing the current price to the projected future price by the end of 2023, investors can expect around an 80% increase in just 1 year. This author is optimistic about NIO stock and recommends looking further into it as a potential long-term winner for your portfolio. However, always make sure to conduct your research. It's essential to obtain information about buying, selling, or holding stocks from a variety of sources. In this case, Wall Street analysts are relatively bullish, and the ABR rating, which ranges from 1 to 5, is currently 1.94, indicating that NIO is trading between a strong buying opportunity and a buying opportunity. The ABR Brokerage Record Foundation surveyed 9 brokerage firms, and overall, it seems that this company is a good buying opportunity. However, institutions such as Zacks Rank, which rates NIO as a 4, believe that it's a strong selling opportunity due to short-term earnings per share and revenue forecast for the upcoming earnings report. But the author believes that as we move towards the second half of 2023, Zacks Ranks may change the rating to a buying opportunity. There hasn't been a recent update from Tip Ranks regarding their opinion of this company's value. In conclusion, it's important to analyze data from multiple sources and conduct thorough research before making any investment decisions. Now, before we continue, please like this video if you are enjoying it so far. Stick around until the end of the video to find out more about NIO. Moving to our last article, let's discuss the top 3 EV stocks that the 4 author recommends buying now. While there are several other promising EV companies, the author wants to draw attention to 3 companies that they believe have tremendous growth potential. These companies are NIO, ChargePoint, and BYD. Let's take a closer look at each of them. NIO is a popular EV company that the author believes has significant upward momentum that it has yet to access. According to the author, this momentum is likely to be triggered by the end of 2023. Additionally, NIO's PS ratio is relatively low, currently sitting at 2.8. This ratio is much lower compared to other EV companies like Tesla, which has a PS ratio of 8.6. However, if we consider the future growth rate of Tesla and NIO about their PS ratios, Tesla could be a better long-term buying opportunity. In terms of value opportunity, NIO seems to be better choice. Overall, there are many reasons to be optimistic about NIO given its low PS ratio and potential for significant growth by the end of 2023. If you are patient and willing to hold shares for a long time, feel free to consider investing in this company. However, make sure not to over-allocate yourself to singular risky growth stocks like this one, especially foreign ones like NIO. Next up is ChargePoint, a fantastic electric vehicle company that I also own. Its ticker symbol is the CHPT. ChargePoint provides electric vehicle chargers for both residential and commercial purposes and has one of the largest electric vehicle charging networks in the United States and China. Analysts predict that the company's sales will increase by over 55% this year, making its fundamentals highly attractive. Although ChargePoint had a similar unsuccessful year in 2022 to NIO, this represents a buying opportunity as the share price has fallen by about 40%. Therefore, you may want to consider buying some shares while they are cheap before the anticipated rally in the second half of 2023. Currently, the company is trading at around $12.64 per share. The long-term investment opportunity for this company is phenomenal. It has numerous upcoming catalysts, one of which is directly related to the United States federal government's goal to implement 500,000 public electric vehicle chargers by 2023. ChargePoint can clearly assist with this initiative. Lastly, we have BYD, and I would like to mention Li Auto as well. Both are Chinese electric vehicle companies, with BYD being the market leader in China based on their overall sales volume. Many investors focus on the long-term potential of BYD's earnings and revenue expansion. It's no surprise that Warren Buffett and Charlie Munger are key investors in this company. Munger has stated that BYD surpasses Tesla in electric vehicle sales in China, which is true. However, I believe that Tesla will eventually catch up to BYD. Nonetheless, why not invest in both companies for the long term? BYD aims to capture the middle-class market in China, while Tesla focuses on premium electric vehicles. They compete with each other but not directly at this moment. However, there is some overlap as they both sell electric vehicles. Thank you for watching our video on NIO stock and its future projections. We hope you found the information helpful in making investment decisions. So, what are your thoughts on NIO's future growth? Do you believe it is a good investment opportunity? Let us know in the comment section below. Thanks for watching. I am Jules. Please subscribe, like, and share this video. If you want to learn more about Mullen Automotive, make sure to watch this video and find out if the company will be delisted from Nasdaq. So click and watch the next video here to know more.